Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Wednesday, everybody. Today's episode will be very economy-focused, especially with the property crisis. If you enjoy the video, don't forget to hit the like button. Liking, sharing, and subscribing are all big helps. China Update is now on Twitter or X at Tony China Update. There's also a link in the description below. There are posts on the China Update X account every day. Hope to see some of you over there too. Let's begin with salient developments related to China's ongoing property crisis. In response to growing rumors that massive real estate developer Vanke may be about to follow Evergrande and Country Garden and implode, with dollar bonds plunging to distressed asset levels last month, the company, along with its largest shareholder and even local government officials in Shenzhen, came out on Monday to tell the market that everything is fine. Vanke is China's second largest property developer by sales volume, and until recently was one of China's few remaining investment-grade builders. On Monday, the largest shareholder of the developer, state-owned Shenzhen Metro Group, said that it was prepared to pump more than 10 billion yuan, $1.38 billion worth of, quote, market tools, end quote, to add new cash flow and liquidity to the developer. The Shenzhen State Asset Regulator also said that it will, quote, coordinate other state-owned enterprises and financial institutes to support Vanke, end quote. It does appear that after letting two of the world's biggest property developers plunge into default, Chinese authorities are attempting to save a third industry giant from following suit. Leonard Law, senior credit analyst with Lucror Analytics, expressed on this development, quote, "The show of support from local authorities for Vanke is stronger than anticipated," end quote, but added that while the move, quote, certainly bodes well for developers partially or fully owned by the state, it's unlikely to benefit those that have already defaulted or to be a turning point for the wider industry, end quote. In a statement on Monday, China Vanke said that it will make sure the company pays its domestic and offshore debt, adding that, quote, there is absolutely no need for the market to be worried about any of this, end quote. A statement which doesn't always instill confidence. China's property crisis, incredibly, is heading into its 4th year. And according to a new report published yesterday by Bloomberg Economics, this prolonged housing slump has resulted, unsurprisingly, in the real estate sector driving less growth and contributing to economic slowdown. This report seeks to quantify the extent of this damage. According to estimates from the Bloomberg Economics report, housing-related demand was an estimated 19.4% of final demand in the first 9 months of this year. That's down from a recent peak of 24.2% in 2018, and it's likely to continue dropping. Bloomberg economists Chang Shu and Eric Zhu in the report observed, quote, shrinking real estate activity will hurt growth in the short term, end quote. Residential property sales were down 3.2% in the first 9 months of this year, and investment in the sector dropped 9.1% over the same period year-on-year. Outstanding property loans through the end of September fell on a yearly basis for the first time on record, and outstanding mortgages in Q3 declined 490 billion yuan, the second straight quarter of year-on-year contractions. Then today, Beijing sent out more signals that yet more government support could be coming for the sector. Chinese financial media outlet Cailian reports that this week the People's Bank of China, the Ministry of Housing and Urban-Rural Development, the China Banking and Insurance Regulatory Commission, and the China Securities Regulatory Commission, quote, jointly convened a discussion with several real estate companies to understand the industry's financial status and the financing needs of enterprises, end quote. It seems incredible that there are still senior regulators that need to talk to the industry like this to get a better idea of the nature of the crisis, though perhaps this is just an opportunity to get an update on the situation. There is one more thing we need to cover while we're on housing. On Monday this week, Shanghai hosted the 6th Hongqiao International Economic Forum. At the event, former Chongqing Mayor Huang gave an unusually frank warning to regulators that China is heading for a hard landing in the distressed property market, which must be avoided. Chinese financial media outlet Caixin, reporting on the comments, writes that Huang argued that, quote, China needs to avoid a 30 to 50% drop in home prices, land auction prices, and home sales as the sector is undergoing a deep structural adjustment. End quote. The development of China's real estate market in the past few decades has led to a high household leverage rate for housing consumption, he said. Quote, Chinese urban households' real estate debt accounts for nearly 138% of household income, compared with 90% in the US. Meanwhile, China's high mortgage interest rates means that urban households spend 15% of their incomes on interest payments, compared with 7.8% in the US and 8 to 9% in Europe. This constrains Chinese households' discretionary income for other consumption. End quote. Huang suggested that the government build affordable residences or buy unsaleable commercial housing and convert it into affordable housing. Currently, there is a glut of middle-class apartments and not enough affordable units for hundreds of millions of low-income households. Huang also, again in a frankness unusual in senior officials, criticized China's current growth model, making points very familiar to regular China Update viewers, expressing, quote, as China is fostering a new development pattern, a dual circulation economic model aimed at expanding domestic demand, the proportion of GDP driven by consumption, investment and exports in the past must gradually shift. Consumption should rise to 50% of the economy from 30%. Investment should decline to 30% from 40%, and exports should drop to 20% from 30%. End quote. To promote consumption, he argues, the first priority will be to increase households' discretionary income and income from other assets other than housing. But what he stressed most of all was that regulators must ensure that China avoid a hard landing in the property sector. Quote, Huang is smart, if marginalized in retirement. His warnings of the dangers of a 30 to 50% drop in home prices should be heeded and keep policymakers up at night. End quote. Next up, we now move to the economy generally. According to official trade numbers published by the General Administration of Customs yesterday, Tuesday, Chinese exports fell 6.4% in October compared with a year earlier to 275 billion US dollars, a steeper decline than the 6.2% fall recorded in September. This is the sixth straight month of declining exports. Imports rose 3%, snapping several months of decline and swinging from a 6.2% fall in September. The new data shows that China recorded a trade surplus of 684 billion US dollars in the first 10 months of 2023. In a note, Citi analysts express with the numbers, quote, the disappointing exports point to external headwinds to the still fragile recovery, while the much better than expected imports suggest domestic demand could be bottoming out on policy support. End quote. Moving on with the economy, the IMF has raised its forecasts for China's economic growth, citing stronger policy support from Beijing. The fund now expects PRC GDP growth to be 5.4% this year and 4.6% next year, expressing, quote, the authorities have introduced numerous welcome measures to support the property market, but more is needed to secure a quicker recovery and lower economic costs during the transition. End quote, and also warns, quote, financial stability risks are elevated and still rising. End quote. The IMF recommends that a comprehensive policy package should include measures to accelerate exit of non-viable property developers, remove impediments to housing price adjustment, allocate additional central government funding for housing completion, and assist viable developers to repair balance sheets and adopt a smaller property market. In addition, the fund says the central government should implement coordinated fiscal framework reforms and balance sheet restructuring to address local government debt stresses, including closing local government fiscal gaps and controlling the flow of debt, as well as developing a comprehensive restructuring strategy to reduce the debt level of local government financing vehicles. Of course, this is all very easy to say, but as we know all too well and which we've explored in depth in previous videos, this is incredibly difficult to do, as it requires deep political and structural reform, higher risks of social instability, and a structural decline in future economic growth. According to the updated IMF forecast, over the medium term, GDP growth is now projected to decline gradually to about 3.5% by 2028 because of weak productivity and an aging population. Meanwhile, with the release of this report on Tuesday, Hong Kong was hosting a flagship global investor conference attended by some of the most powerful executives in global finance, including Morgan Stanley's James Gorman and Goldman Sachs' David Solomon. We remember in yesterday's video, investors have been pulling large amounts of capital out of China for months now. At the Hong Kong investor event, top officials put on a brave face for the international capitalists. Zhang Qingsong, deputy governor of the People's Bank of China, told the audience, quote, "You may ask me, are you worried? Not too much. Our economic fundamentals are stable and government debt is lower than in many other advanced economies." End quote. Of course, as regular viewers know, if we include local government debt and local government financing vehicle debt, then this is not the case at all. And in a statement that caught headlines, Wang Jianjun, vice chair of the China Securities Regulatory Commission, despite China's benchmark CSI 300 index having fallen more than 6% this year, said equity markets were still, quote, "full of opportunities right now," end quote, adding, quote, "It's never too late to catch the China train. You can still ride the dragon up to the heavens," end quote. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a good Wednesday, and I will see you all tomorrow.